public story is simple. The Shanghai Futures Exchange suspends 22 accounts in 7 days, and the headlines scream silver manipulation. That's the bait. The real mechanism is colder, more structural, and far more dangerous. When the dollar liquidity machine tightens and collateral stress spreads through funding markets, the first places that crack are the markets where leverage meets deliverability. Precious metals futures, especially silver, because it's small, thin, and unbelievably sensitive to inventory and delivery constraints. The SHFE crackdown isn't the start of the story. It's a symptom, an early tremor, of a global system that is shifting from easy, expanding liquidity to constrained, defensive liquidity. And that shift has a habit of exposing manipulation, not as a conspiracy, but as a predictable byproduct of a system where paper claims outnumber physical deliverable supply by orders of magnitude, where price is often a funding rate in disguise, and where exchanges become the battlefield for a fight that is fundamentally about dollars. Here's the shocking claim that investors hate because it sounds too deterministic. The silver episode is not an isolated scandal. It's the next phase of a repeating monetary pattern. One that begins with a stable foundation, expands into overextension, breaks into crisis when funding and confidence collide, and ends in an outcome that looks political but behaves like math. Roughly, and this is the part you can verify in broad strokes from multiple recent estimates, something like 90% of global FX transactions touch the US dollar on one side. That's not a brag, it's a dependency. When the world's trade, debt contracts, commodities pricing, and reserve management are structured around the dollar is not just a currency. It's the plumbing. And when plumbing pressure changes, it doesn't matter what the faucets are labeled. The flow changes everywhere. The inevitability is this. Once you understand the sequence, you stop asking whether the next stage will arrive. And you start watching for the signals that it already has. That's what this week's silver manipulation story is. One of those signals. Markets love narratives about bad actors because they're emotionally satisfying. A few accounts, a few traders, a few spoofing algorithms, clean villains. But macro finance rarely collapses because of villains. It collapses because the system's incentives force the same behavior from thousands of participants at once, all pulling on the same leverage funded by short-term dollars. In that world, manipulation is often just the label we slap on the moments when leverage and deliverability collide, when paper markets are asked to behave like physical markets, when futures are asked to clear like warehouses, when margin collateral is asked to function like cash, and when a central bank is asked to solve a political problem with a balance sheet. And it always becomes visible first in places where the ratio of paper claims to physical reality is extreme. Silver is extreme by design. The market is smaller than gold, more industrially tied, more sensitive to supply chains, and more vulnerable to inventory drawdowns. It's where a small funding shock can create an outsized price move. It's also where an exchange's credibility can be tested quickly because silver's deliverable stocks are not infinite, not easily conjured, and not always where the contract says they should be. That's why silver often behaves like a stress meter. When liquidity is abundant, the paper market can float above the physical market, smooth and liquid, with spreads tight and delivery optional because most positions roll. When liquidity tightens, the paper market starts to scrape against the physical constraints. Premiums emerge. Inventory levels matter again. Delivery notices become more than a footnote. And suddenly the exchange is forced into governance. Margin changes, position limits, account suspensions, market integrity announcements. The public reads that as policing. The professional reads it as triage. To see what's happening, you have to stop viewing silver as a commodity and start viewing it as a collateralized claim. Futures markets are not just price discovery, they're leverage discovery. They are the places where you can control large notional exposure with relatively small capital, with the rest financed implicitly through margin, credit lines, and the broader collateral ecosystem. When the world is flush with dollar liquidity, those structures feel stable. When dollar liquidity is scarce, when repo rates get jumpy, and when cross-currency basis widens, when dollar funding is demanded more aggressively, the same structures become unstable. The stress then migrates into the most levered, most deliverability-sensitive corners. That's silver. So when you see an exchange take dramatic action, it's rarely because the exchange suddenly developed moral outrage. It's because the exchange is protecting its clearing system against the mechanical consequences of strained funding. The pattern behind this is old, boring, and terrifying precisely because it repeats. It begins with a credible foundation, a monetary regime that is trusted because it appears anchored by gold, by a peg, by fiscal restraint, by political legitimacy, or by the implicit promise that the central bank will not sacrifice the currency to save the system. Then comes the expansion phase. Credit grows faster than real output. Debt becomes the growth model. Deficits become normalized. The currency's role expands globally. And leverage grows in the private sector because the state appears stable. The third phase is where everything becomes visible. A crisis of control, not always a crisis of solvency at first. Funding markets start to seize impulses. Bond yields behave strangely, either surging because inflation expectations rise or collapsing because growth expectations crash, often in alternating waves. Volatility increases and correlation structures change. The currency's dominance becomes a weapon and a liability. It transmits inflation or deflation across borders through FX. The fourth phase is the outcome. Some combination of devaluation, institutional restructuring, capital controls, political reset, or a new anchor. It's inevitable not because history is scripted, but because the incentives and constraints in each phase generate the next phase. That's what makes it mathematical. Once you push the system past certain thresholds, debt to income, deficit to funding capacity, leverage to collateral, you don't get to vote your way back to stability without paying a price. Notice how this mechanism doesn't require a single bad actor. It requires only one thing: a system built on promises that outgrow the collateral supporting them. That's the entire modern dollar system. The dollar is the base layer, the unit in which global debt is written, the currency that commodities are priced in, and the reserve asset that everyone holds because everyone else holds it. That network effect is powerful until it forces the same reaction from everyone at once. When stress hits, every entity wants more dollars, not fewer, because dollars are the settlement asset. That's how deflationary shocks happen in a debt-based system. Scarcity of settlement currency, not scarcity of goods. But when policymakers respond by injecting liquidity, you can get inflation transmission, especially into commodities and imported goods, especially for countries whose currencies weaken against the dollar. That tug-of-war between deflationary funding stress and inflationary policy response creates the violent cycles that make investors feel like the world is manipulated. It's not manipulated, it's collateralized. Before we attach this mechanism to today, you need to see it work in the real world, with names and dates and decisions, not as history trivia, but as proof of the pattern. The first case study is the United States itself, because it's the template the world is still living inside. Start with the foundation. After World War II, the Bretton Woods system anchored the dollar to gold at $35 an ounce, and tied other currencies to the dollar. It was not perfect, but it was credible because it imposed a constraint. The US promised convertibility for official holders, and the world accepted the dollar as the settlement unit. That was the setup phase. Now watch the expansion. In the 1960s, US fiscal commitments expanded. Vietnam War spending, Great Society programs, and the global use of dollars increased dramatically. Dollars flowed abroad through trade and military spending, while foreign central banks accumulated dollar claims. This is the crucial mechanical point. The world held dollar liabilities that were, in theory, convertible into US gold. But the US gold stock did not expand in proportion to the claims. The paper claims grew faster than the physical anchor. That is the expansion and overextension phase. It isn't moral failure, it's arithmetic. Then came the crisis of control. By the late 1960s and early 1970s, foreign governments and central banks began testing the system, converting dollars into gold, draining US reserves. The US faced a choice: defend the convertibility promise by tightening dramatically and shrinking global dollar liquidity, or abandon the anchor. In August 1971, President Nixon chose the outcome that the math demanded: the Nixon Shock, the closing of the gold window, effectively ending dollar convertibility into gold for foreign official holders. That moment is often described as a political decision. It was, but it was also the fourth stage outcome of the mechanism. Once the liabilities exceeded the anchor, convertibility had to break, or the system had to contract violently. Nixon chose break. The world then entered the 1970s, and the consequences were textbook. Inflation surged, oil shocks amplified price pressures, and the dollar's purchasing power eroded. Bond markets repriced the reality that the currency was no longer constrained by a hard anchor. Yields rose across the decade. Inflation expectations became embedded. Volatility became a feature, not a bug. Now focus on what matters for our silver story. In periods when the currency anchor breaks and inflation expectations rise, precious metals become the stress valve. Gold repriced. Silver, smaller and more volatile, experienced dramatic swings. That is not superstition. It is a rational response to monetary debasement and to the desire for an asset that is not someone else's liability. And the mechanics become more intense when leverage is involved. In the late 1970s and into 1980, silver became the stage for one of the most famous episodes of market stress and exchange governance: the Hunt brothers' attempt to accumulate massive silver positions. Well, they were painted as manipulators, and they were certainly aggressive. But what made the episode explosive wasn't merely their intent, it was the structure. A leveraged futures market tied to a physically constrained deliverable supply in an environment of rising inflation expectations and unstable funding is an unstable system. Exchanges respond with rule changes, margin hikes, and position limits to protect clearing. Prices spike, then collapse when leverage is forced out. The public calls it manipulation. The professional calls it what it is, a leverage and deliverability collision amplified by monetary regime stress. Same mechanism. You can map every stage cleanly. The foundation was Bretton Woods convertibility. The expansion was fiscal overreach and global dollar claim growth. The crisis was the run on U.S. gold and the inability to maintain convertibility. The outcome was the gold window closure and the inflationary 1970s, with precious metals repricing and volatility spiking. That is not a story about one villain. It is a story about a system hitting its constraint and choosing which promise to break. The second case study is a different nation, a different century, and the same mechanism. The United Kingdom's forced exit from the exchange rate mechanism in 1992, Black Wednesday. This is important because it shows how a modern developed economy can still be trapped by the math of defending a currency regime when domestic conditions conflict with the peg. Start with the foundation. The ERM was designed to stabilize European exchange rates by keeping currencies within a band against each other, with the Deutsche Mark as the anchor in practice because Germany's monetary credibility was the strongest. Britain joined the ERM in 1990, committing to keep the pound within a defined range. That commitment was a credibility play, stability, lower inflation, integration. It was the setup stage. Then came the expansion and overextension phase, not in the sense of fiscal explosion, but in the sense of mismatched policy constraints. After German reunification, Germany faced inflationary pressures and raised interest rates. Britain, however, faced a weak economy and needed lower rates to support growth and relieve domestic stress, but the peg required Britain to maintain rates high enough to defend the pound. In other words, the system's promises became inconsistent. The promise to maintain the exchange rate band conflicted with the need to manage domestic conditions. That inconsistency is a form of overextension. It is the currency regime, stretching beyond what the economy can sustain. Then came the crisis of control. Speculators saw the mismatch. If Britain couldn't keep rates high without crushing its economy, and if its foreign exchange reserves were finite, the peg could be attacked. Selling pounds forced the Bank of England to spend reserves buying pounds, and to raise rates to attract capital. But in a world of mobile capital, deep markets, and one-way bets, reserves can be drained quickly. On September 16, 1992, Black Wednesday, the UK attempted to defend the pound with massive interventions and dramatic rate announcements. It failed. The reserves weren't enough. The market's conviction was stronger than the peg's credibility. The outcome was inevitable once the mismatch was visible. Britain withdrew from the ERM and allowed the pound to devalue. Again, the outcome looked like politics, but it was math. Defend the peg by imposing intolerable domestic pain and exhausting finite reserves, or abandon the peg. The system chose the promise to break. Now, why does this matter for dollar liquidity and metals? Because every currency regime is a promise, and promises are enforced by balance sheets. When confidence breaks, funding stress appears. Interest rates become weapons. Bond yields become signals. Volatility spikes because the market is repricing the entire structure of future cash flows and the credibility of the regime. In Black Wednesday, the crisis manifested in FX directly. In the Nixon era, it manifested through gold convertibility and then inflation. In both cases, the same mechanical sequence is visible: a stable commitment, a period where that commitment becomes inconsistent with real conditions, a crisis where reserves and credibility are tested, and an outcome where the regime changes. Translate this into the modern global system, and you start to see why manipulation stories pop up where they do. Because the modern regime is not a simple peg or gold convertibility. It is a global dollar funding regime where the promise is implicit. Global trade and finance can be settled in dollars smoothly, dollar liquidity will be available through markets, and U.S. Treasury collateral will remain the ultimate risk-free asset that can be financed at scale. That is the foundation. The expansion is the explosion of global debt and leverage built on that foundation. Trillions in dollar-denominated liabilities outside the U.S., massive derivatives exposures, carry trades, and the constant rolling of short-term funding against long-term assets. The overextension is obvious. Debt rollovers depend on stable auctions and stable funding markets. Fiscal deficits depend on continuous absorption of treasuries. Risk assets depend on liquidity cycles. And foreign central banks depend on stable FX conditions to manage inflation transmission. Everyone is stable as long as everyone else is stable. That's the trap. When the crisis phase begins, it doesn't announce itself with a headline saying, "The system is breaking." It announces itself with behavior. Funding spreads widening, auctions requiring higher yields to clear, volatility clustering, emerging market currencies weakening as dollar demand rises, imported inflation surging in weaker currency economies, and commodity prices swinging violently as the market alternates between deflationary liquidation an inflationary policy response. And in that environment, precious metals become the honest broker, the pressure release, the asset class that says out loud what everyone else is trying to obscure. Whether the currency regime is being defended through tight money and scarce dollars, or abandoned through liquidity injections and debasement risk. This is where silver's microstructure becomes macro. Silver is not just an inflation hedge. It is a market where the distinction between paper exposure and physical availability is constantly tested. Futures contracts are, in principle, deliverable. But in practice, most positions settle financially or roll. That works when funding is easy. When funding is hard, rolling is not free. Margin costs rise, financing costs rise. Participants who are used to living in abundant liquidity start to demand certainty, physical metal, allocated bars, immediate delivery, because counterparty risk feels different when volatility rises and when currency stress spreads. That shift changes everything. If the paper market's price is set by leveraged participants who assume rollability, and if the physical market's premiums rise because real buyers demand delivery and inventories draw down, you can get a divergence between paper price and physical reality. The public calls that manipulation. It's not. It's a liquidity regime change expressed through a commodity that cannot be printed. Gold is the larger and more globally recognized monetary metal, and it often moves first in the macro narrative. But silver is the more violent messenger because its market structure can be overwhelmed more easily. A modest amount of forced buying or forced covering can move prices dramatically. A modest inventory drawdown can change delivery expectations. A modest change in margin requirements can trigger liquidation cascades. And in a world where exchanges are the clearing nodes, the stability of the exchange becomes a systemic concern. That's when governance actions appear: suspensions, bans, risk controls. Again, the exchange isn't the moral guardian, it's the firewall. When SHFE suspends 22 accounts in 7 days, you should not imagine 22 cartoon villains being led away in handcuffs. You should imagine risk managers watching stress indicators, margin utilization, and position concentration, and deciding that the clearinghouse cannot tolerate a particular cluster of behavior in a market that is now sensitive to delivery and funding simultaneously. The dollar system is the engine behind the sensitivity, because when dollars tighten, everything priced in dollars becomes a battlefield. A stronger dollar is not just an FX move, it is a global tightening of financial conditions. Emerging market borrowers with dollar debt face higher local currency costs to service liabilities. Importers face higher costs for dollar-priced commodities, transmitting inflation domestically even as demand weakens. Central banks respond with rate hikes to defend their currencies, tightening domestic conditions further. That's how you get synchronized stress and volatility. Meanwhile, U.S. bond yields reflect the tug of war. Higher yields can mean the market demands compensation for inflation and deficits. Lower yields can mean growth expectations are collapsing, and the market is seeking safety. But both can coexist over short windows through violent repricing, yields up on inflation scares, then down on risk-off, then up again on auction indigestion. This is what a regime transition looks like. It is not a straight line, it is a sequence of jolts. And those jolts matter because treasuries are not just debt, they are collateral. The modern financial system is built on the ability to finance treasuries and repo markets, to use them as margin, to use them as the base of leverage. If auctions become more difficult, if yields must rise to attract buyers, if volatility in rates increases, the entire collateral ecosystem feels it. Haircuts change, funding costs change, leverage ratios change, risk parity models change, duration hedges change. The system becomes more fragile. In that fragility, safe assets behave in ways that shock people. Gold can surge on debasement fears, then dip on forced liquidation, then surge again when the policy response arrives. Silver can overshoot in both directions. Physical premiums can rise even when paper prices fall, because the paper market is liquidating leverage while the physical market is absorbing real demand. Inventory drawdowns become meaningful because they constrain the ability of the paper market to pretend indefinitely that delivery doesn't matter. These are the mechanics you must watch. They're boring. They're terrifying, and they explain why a local exchange action in China is not local at all. 2 historical case studies have already shown the skeleton: Bretton Woods to Nixon in the 1970s, and ERM to Black Wednesday. Different continents, different decades, same pattern. The system builds credibility, expands commitments beyond its capacity, hits a control crisis, and breaks a promise in an outcome that appears sudden only to those who didn't track the constraints. The silver crackdown fits inside the same skeleton. It looks like discipline. It is actually a signal that deliverability and leverage are being tested in the context of broader funding stress. Now we need to do what most commentary refuses to do: connect the micro event to the macro plumbing with no superstition. We need to walk the present-day system through the same stages: what the foundation is, how the expansion happened, where the crisis pressure is building, and what outcome the market is already pricing in through FX, bond yields, volatility, and the gold-silver complex. Because once you map the mechanism onto today, the question stops being, did someone manipulate silver? And becomes, why is the system forcing silver to behave like a warning siren right now? That is the bridge we have to cross next. So now we cross the bridge you can't unsee. If silver is acting like a siren, it's because the system is leaning on it, because the dollar plumbing, the collateral engine, and the leverage culture are all being forced to adjust at the same time. The manipulation headline is what people say when they can't admit the more uncomfortable truth. The regime is changing, and the first markets to show it are the ones that mix leverage with deliverability. Before we apply the mechanism to the present in full, there's one more historical proof point we need. One that fuses currency stress, funding stress, and the metal as escape dynamic into a single brutal case. The Asian financial crisis of 1997 to 1998 is often told as a story of hot money, weak banking systems, and fixed exchange rates that snapped. That's true, but incomplete. What matters for our pattern is how a dollar-linked foundation turned into a debt-fueled expansion, then became a crisis when the dollar rose and funding tightened and finally ended in a forced outcome. Devaluations, IMF programs, recession, and a permanent change in how those economies managed reserves, current accounts, and foreign funding. Start with the foundation. In the early 1990s, several Asian economies effectively pegged their currencies, formally or informally, within a narrow range against the US dollar. It created stability for trade and investment, and it imported credibility. The dollar anchor reduced perceived FX risk, which reduced the cost of borrowing. Capital flowed in. Domestic credit expanded. Property and equity booms followed. Oh, this wasn't greed. It was a textbook incentive structure. If your currency is stable against the dollar and your growth rate is high, borrowing in dollars or in dollar-linked terms looks rational. Then came the expansion and overextension. Corporates and financial institutions piled into short-term foreign currency liabilities. Maturity mismatches grew. Projects with long payback periods were funded with short-term money. External debt increased, often unhedged because the peg made hedging look unnecessary. The paper looked stable, right up until the moment it wasn't. Then the crisis of control arrived. And it arrived exactly where our mechanism predicts. The funding and FX constraint collided. Thailand's baht was attacked first in 1997 after reserves and forward positions were questioned. Defending a peg requires dollars, real dollars, because you're buying your own currency and selling the anchor currency. But reserves are finite, and when market participants see that your external liabilities exceed your liquid dollar buffers, the peg becomes a one-way bet. Thailand devalued in July 1997. Contagion spread quickly to Indonesia, Malaysia, the Philippines, and South Korea. FX depreciation turned dollar debt into a crushing domestic burden. Corporate balance sheets detonated. The banking system seized. Rates spiked. Growth collapsed. And governments were forced into painful policy choices and external assistance. The outcome was inevitable once the mismatch was exposed. Abandon the peg, restructure debt, recapitalize banks, accept IMF terms in some cases, and rewrite the social contract through recession and political upheaval. And here is the key metallic link. In a crisis where local currencies collapse against the dollar, imported inflation erupts, even as domestic demand implodes. That's the inflation-deflation paradox of dollar stress. Locally, the economy deflates. Credit contracts, asset prices fall, unemployment rises. But the currency collapse inflates the local price of anything priced in dollars. Energy, food, and yes, precious metals. Gold becomes a refuge when the domestic unit is failing. In multiple crisis economies, gold demand surged because people needed an asset that was liquid outside the banking system. Not because they loved shiny objects, but because they were exiting a broken promise. The pattern holds. Foundation of a stable regime, expansion via debt, crisis via funding FX, outcome via devaluation, and structural reset. That is the third proof point. And it matters because today's world is not safe from that dynamic. It is globally synchronized through the dollar system itself. Now we apply the mechanism to the present, step by step, without superstition, because the current system has the same skeleton but larger scale and more sophisticated leverage. The foundation today is the post-2008 and post-2020 world. The dollar sits at the center of trade invoicing, global debt issuance, commodity pricing, and derivatives settlement, while U.S. Treasuries function as the core collateral asset for the world's financing machinery. The belief embedded in the system is not written on paper, but it is treated like law. Treasury markets will remain deep and liquid, auctions will clear smoothly, repo will function, and when stress hits, the central bank can add liquidity without breaking the currency's credibility. That's the foundation. Check. The expansion and overextension is visible in three places at once. First, the scale of sovereign issuance. Deficit funding becomes routine, and the market must absorb large, frequent auctions across bills, notes, and bonds. Second, The growth of leverage structures that treat Treasuries as risk-free inventory to be financed, relative value funds, basis trade participants, and dealer balance sheets that rely on stable repo conditions. Third, the global web of dollar liabilities, borrowers outside the U.S. who issue dollar debt, hedge imperfectly, and depend on stable cross-currency funding to roll. The entire machine assumes that funding spreads remain contained, that term premium doesn't reprice violently, and that real yields can rise without cracking balance sheets. Verified. Then the crisis phase begins the way it always does. Not with a headline, but with a change in pricing behavior that reveals stress in the plumbing. Watch the auctions. Bid-to-cover ratios are a simple but brutal indicator. How much demand shows up relative to supply. When bid-to-cover softens, when tails widen, meaning the auction clears at a higher yield than expected, it's a message that the marginal buyer is demanding more compensation. Watch the term premium. When investors are uncertain about inflation persistence, deficit trajectories, and supply, they demand extra yield for holding duration risk. Watch real yields. When real yields rise, they tighten financial conditions mechanically, pressuring risk assets and increasing funding strain. Watch swap spreads. When swap spreads behave erratically, it's often a sign of balance sheet constraints, hedging demand, and collateral dynamics shifting. Undeniable. Now connect that to dollar funding stress. In tight conditions, the cost to borrow dollars rises, and it rises in ways that aren't always visible in a single headline rate. Cross-currency basis can widen, meaning non-US entities pay a premium to swap their currency into dollars. Repo markets can show spikes around quarter ends and stress windows, reflecting balance sheet constraints and collateral scarcity. Dealers can step back, not because they don't want to make markets, but because their balance sheet is finite and costly. When collateral gets special in repo, meaning specific Treasury issues trade at unusually low repo rates, it signals scarcity and high demand for particular collateral. Meanwhile, the basis trade, a strategy of buying cash Treasuries and shorting futures to capture small spreads, depends on cheap, stable repo financing. When repo costs jump or haircuts rise, the trade can unwind, forcing sales of cash Treasuries into a market already digesting heavy issuance. That is how a seemingly technical funding shift becomes a macro event. It pushes yields higher, increases volatility, and tightens conditions globally. Check. FX is where the stress transmits. When dollar funding tightens, the dollar tends to strengthen, not always smoothly, but often in bursts, because global entities scramble for the settlement asset. A stronger dollar is a tightening impulse exported to the world. It pressures emerging market currencies, it raises the local currency cost of servicing dollar debt, and it forces central banks into defensive postures. Some hike rates to defend their currencies, importing recession risk. Others let currencies slide, importing inflation. Either way, the system transmits stress. This is not a moral argument, it is arithmetic. Verified. Inflation and deflation then become two faces of the same cycle. Tight dollar liquidity and high real yields are deflationary for assets. They compress valuations, they force deleveraging, they reduce risk appetite. But FX weakness outside the US can be inflationary in goods prices, because imports are priced in dollars. Commodity prices can swing violently depending on whether the market is dominated by liquidation or by policy response expectations. That's why you can see risk assets falling while local inflation stays sticky, or commodities spiking while growth weakens. The public calls it confusion. It's the system oscillating between the deflationary pull of debt and the inflationary push of currency weakness and policy reaction. Undeniable. Now follow the chain into volatility. When yields become unstable and the dollar surges and pulses, correlations change. Stocks and bonds can sell off together if term premium rises and inflation risk is repriced. Volatility is no longer a hedge. It becomes a tax. Margin requirements rise, VAR models tighten, risk budgets shrink, and the forced seller emerges. Funding markets don't need a crash to impose discipline. They only need enough volatility to raise the cost of carry. That's when the system begins eating its own leverage. Check. And now, this is the part that connects directly back to silver and the SHFE actions. Watch where the stress goes when leverage is forced to adjust. It goes to the markets, where paper claims are easiest to create and hardest to reconcile with physical reality. Precious metals futures are exactly that, and silver is the most sensitive among them. The paper market can represent enormous notional exposure relative to deliverable physical stocks. Most of the time, that's fine because most contracts are rolled or netted. But when funding stress rises, when counterparties distrust each other, and when volatility spikes, the incentives shift. Some participants want out-of-paper promises. They want metal, not exposure. They want delivery, not P&L. They want allocated, not unallocated. That demand doesn't need to be massive to matter. It just needs to be persistent against a constrained supply chain. Here's what it looks like in plumbing terms. Futures prices can be pushed around by leveraged flows, but physical premiums can rise at the same time because real-world supply is tight. Delivery becomes meaningful when inventories draw down. Warehouse reports start to matter because they reveal the buffer. If stocks eligible for delivery fall, if withdrawals accelerate, if the market senses a mismatch between claims and availability, the cost of securing physical rises. Premiums widen over spot. The spread between paper and physical becomes a stress indicator. That is when exchanges become aggressive. They monitor concentrated positions, margin utilization, and potential delivery strain. They don't want a default. They don't want a credibility event. They impose limits, suspend accounts, raise margins, tighten rules, and the public reads it as manipulation exposed, while the reality is closer to clearing risk managed, verified. Gold behaves similarly, but with different scale and different sensitivity. Gold is deeper and more globally monetized. It is central bank adjacent. In periods of currency stress and negative confidence in policy, gold becomes the reserve asset that is nobody's liability. Silver, by contrast, lives at the intersection of monetary stress and industrial constraints. That makes it prone to explosive swings. When liquidity is abundant, silver can lag and then catch up violently. When liquidity is scarce, silver can be smashed by liquidation, then rebound sharply as physical demand asserts itself. The swing is the message. The market is not discovering value, it is discovering the price of funding and the credibility of paper claims. Undeniable. Now place SHFE into this picture. China sits at the crossroads of industrial demand, commodity processing, and the broader geopolitical push to reduce dollar vulnerability. Its exchanges are not just marketplaces, they are policy-sensitive institutions. A sudden wave of suspensions in a deliverability-sensitive market says the exchange is actively managing risk behavior during a time when metal flows and paper positions may be diverging. You don't need to claim conspiracy to understand the motive. In a tightening global dollar environment, every major financial node becomes more defensive. And precious metals are not just assets, they are alternative settlement credibility. Check. If you want the clean, step-by-step mapping to the mechanism we defined, it's this. The foundation is the dollar-centric settlement and collateral regime anchored by Treasuries. The expansion is the explosion of debt, leverage, and the assumption of perpetual liquidity. The crisis is the repricing of term premium, higher real yields, funding stress, and FX volatility. And the outcome is the forced revelation of which promises are real and which are paper. Silver and gold are not causing the stress. They are measuring it, verified. So what do you do with that, practically, before the market forces you into action at the worst possible moment? First, stop watching headlines and start watching indicators that measure the machine. Watch Treasury auction health, bid to cover, tails, dealer takedown, and whether longer maturities require persistent concessions. Watch real yields and the term premium, because they are the gravity that pulls risk assets down and strains funding. Watch dollar funding stress through cross-currency basis and any persistent dislocations between cash and derivatives markets, because those are early warnings of balance sheet constraints. Watch repo conditions around stress windows, because repo is where the collateral engine either hums or seizes. Watch swap spreads and volatility surfaces, because they reveal hedging demand and balance sheet capacity. Undeniable. Second, in metals, stop thinking in terms of price targets and start thinking in terms of structure. Watch physical premiums versus paper price. Watch reported inventories and the pace of drawdowns. Watch delivery behavior and any rule changes, margin changes, or position limit enforcement by major exchanges, because those are the moments when the paper market is being forced to acknowledge physical constraints. Watch the gold-silver ratio not as a magic number, but as a volatility and liquidity signal. Silver's relative weakness can indicate forced selling, and its violent rebounds can indicate stress demand breaking through. Check. Third, in FX, watch the pressure points. When the dollar strengthens sharply, ask what's driving it. Is it growth differential or is it funding stress? The second is the one that breaks things. Watch the currencies of economies with heavy dollar liabilities and thin reserves, because they are the first to transmit stress into global risk sentiment. Watch commodity importer currencies during dollar strength, because that's where inflation transmission bites. Verified.